All right, let's talk about Netskope. Today, we're digging into their very first earnings report as a public company. Now, fresh off their IPO back in September 2025, the cybersecurity giant came out and posted what, on paper, looked like an absolutely killer quarter. But the market's reaction? It was brutal. So let's break down exactly what happened.
And this is the real head-scratcher. Netskope beat Wall Street's estimates for both revenue and earnings. I mean, that's usually the perfect recipe for a stock to soar. Instead, shares tanked, dropping nearly 12%. So what on earth went wrong here? Why did such a great report card lead to such a punishing day on the market?
Okay, so here's how we're going to get to the bottom of this. First, we'll tackle the paradox itself. Then we'll look at the seriously impressive numbers behind that earnings beat. After that, we'll dive into the growth story management was telling. The fourth point is the crucial one, the forward guidance that pretty much sank the stock. And finally, we'll wrap up with our take on what you should be watching for in the next call.
Let's get right into it. You know, Netskope's first earnings call is just a perfect case study in that classic disconnect between a company's results and the market's reality. It really shows you how a company can nail all its targets for the quarter and still watch its stock get absolutely hammered.
I mean, just look at this contrast. It is so stark. Over on the left, you've got the results. They beat revenue expectations by more than $8 million, and their non-GAAP earnings beat by a whopping 15 cents per share. But then look to the right, at the market's reaction, an almost 12% drop in the stock price and on really heavy trading volume too. That's a clear signal that the big investors were heading for the exits.
So, before we get to the real reason for that big drop, let's actually appreciate the numbers that had management so fired up. Because, let's be clear, the underlying business performance this quarter was, without a doubt, really impressive.
First up, annual recurring revenue, or ARR. For a subscription business like Netskope, this metric is everything. They hit $754 million, which is up 34% from last year. That shows some seriously strong and accelerating demand for what they're selling.
Next up, remaining performance obligations, or RPO. You can think of this as a crystal ball for future revenue. It's the total value of all their signed contracts. Well, Netskope's RPO crossed the $1 billion mark, growing at an even faster clip of 41%. That tells you their sales pipeline is absolutely humming.
Now this shows you incredible customer loyalty, a net retention rate of 118%. What that means is that for every dollar they made from a customer last year, they made $1.18 this year. Their customers aren't just sticking around, they're spending more money. It's a textbook land and expand strategy working perfectly.
So you're probably wondering, how are they getting to that 118%? Simple. They're selling more stuff to their existing customers. As you can see right here, their clients are buying into the whole platform. Over half of them are using 4 or more products, and more than a quarter are using 6 or more. That right there is the engine driving their growth.
So these strong numbers really laid the foundation for the story that management was telling investors. And it's a narrative that's laser-focused on some huge long-term growth drivers.
CEO Sanjay Berry tied their growth to 2 of the biggest trends in tech right now, the massive migration to the cloud and, of course, the explosion in AI. His pitch was pretty straightforward. Hey, these trends are creating all kinds of new security problems, and Netskope is the solution.
And during the Q&A with analysts, they just kept hammering these same points home. They really emphasized that securing AI is a huge new driver for their business. They also highlighted the big shift away from old-school VPNs to what's called Zero Trust Network Access, or ZTNA, for secure remote work. But the big takeaway was this idea of platform consolidation. Companies are just getting tired of juggling dozens of different security products. They want one single solution like Netskope One. Okay, so strong results, great story, everything's looking up, right? Well, now we get to the part that mattered most to Wall Street, the guidance for the future. And this is what turned a fantastic quarter into a really bad day for the stock. This table tells the whole story. The revenue forecast for the next quarter and the full year, totally fine. But then you look at the operating margin and the earnings per share. They are still projecting significant losses. For a new high-growth stock, investors really wanted to see a clear, fast path to actually making money. This guidance signaled that profitability was, well, further away than the market was willing to wait for. And this quote from a market research report just hits the nail on the head. The stock was priced for perfection. That means investors had already assumed flawless execution and massive growth was a given.
So the second the guidance even hinted that the path to profitability might not be a straight line up, the market sold off. For a stock like this, it is always about what's next, not what just happened.
So, where does all of this leave Netskope? Here's what we think you need to be watching for in their next earnings call.
We're focused on three main things. First, they absolutely have to hit that Q4 revenue guidance. Missing on your first ever forecast would be a huge blow to credibility. Second, we're watching that net retention rate very closely. Can they keep it up there around 118%? And third, we need to see real proof points, hard evidence that their whole AI security story is actually turning into big money contracts.
And all of this brings us to our final rating, market perform. Now, this really reflects the tension at the heart of this company. You've got a fantastic product in a massive, growing market, but it's also trading at a premium valuation, with brand new questions about its path to profitability. We expect the stock to basically trade in line with the rest of the market until management can prove they have a clear, improving trend in their profit margins.
And one final, very important note. This is not financial advice. This analysis is for informational purposes only.